I see tokenization as the successor to digitization. Once we see a vehicle being represented on chain, or a real estate, or a mortgage contract, there is a whole new future of financial products coming. This is amazing. Like, blockchain has an amazing future ahead. This is just the beginning of that, right? And yeah, we simply placed a big bet on this.
I have with me Phillip Zentner, the founder and CEO at LI.FI.
Data. I want to understand which assets are available on which chain ever, and at which price are these assets available. On top of that, I need to understand, if I want to get from A to B, what are the potential routes you would have to swap an asset so that you can bridge and then swap again. So this is complex, and it implies the user would have to sign 3 transactions. That's a manual effort. We definitely don't want to have a failed $10 million transaction. So instead of having to do that, LI.FI built a multi-chain transaction rail. This rail is a set of smart contracts that lives on all these chains and allows us to combine a variety of transactions into one. Now we are doing 2 new things. The one thing is,
Phillip, you've been recently talking about RWAs and how that impacts interop. I would love to know what your thesis is.
I don't believe that RWAs impact interop per se. It is more that interop is the default today. It's given. It's necessary to even start any company in this space. You need multi-chain connectivity, and may it just be that your users have an easy way to find you. All right, it's about the user's journey. And then with RWAs, of course, we also see a lot of minting on multi-chain native assets, or token standards like OFTs, NTTs, ITS, or CCTs. This is very interesting to see, obviously. So this shows that the modus operandi, or like the default paradigm, already is multi-chain for these people, and that's obviously great to see. And we see RWAs being minted on so many chains, from Evernote, Gnosis to Solana, Sui, but also companies building their own chains and issuing assets there, like Robinhood Chain, for example, right? So it is as multi-chain as we foresaw it years ago, and for LI.FI, that's obviously great.
In terms of the subcategories of RWAs, treasuries, private credit, what is the most interesting to you right now?
I think there are multiple observations. We see a lot of assets being tokenized, but that alone is not enough, right? They need to be liquid, and they need to find distribution, and then ultimately they need to find demand. And distribution and demand is a very typical chicken and egg problem, right? So why would MetaMask take the effort to specifically index RWAs if they don't know what is more important to them, doing that or making sure they support Mega ETH on day one? So that, as per usual, conflicting priorities, and I believe that institutions are still figuring out what distribution even means. Does it mean to be tradable with lower fees and 24/7 within Robinhood and Revolut, or does it mean we want to get the DeFi native crowd into stop trading meme coins and start trading real stocks, but on chain? And I think there is little right or wrong here right now. For me, we are very, very early in the RWA phase, and I'm so happy to see that institutions are getting their hands or their feet wet and trying things out. But for me, it's still pretty much a trial period for many of those, and there is still a huge lack of domain-specific and industry-specific knowledge within these companies, and we will see how this will plays out. For me, it's funny. Like, we are in a. I was just discussing this with my team this week. It feels like the past 4 or 5 years has been the DeFi era, DeFi meme coin, just like, I don't know, DeFi trying to figure itself out era. And now this kind of feels like ending. The space is consolidating heavily. People don't believe in protocols that much anymore. You can see this reflected in early stage funding, which is pretty much dried out at the moment. At the same time, we see the big players, TradFi, coming in, but they are obviously very early. So what I'm foreseeing is kind of like a hole in which we see volumes potentially being very isolated around certain in certain isolated environments. I give you an idea. So let's say JP Morgan issues $1 trillion in tokenized assets within Canton network, within their own private chain. Then we might see a lot of crypto volume turnover between their clients on that one chain, but none of existing crypto really profits from it. I mean, the outside image is there, and then JP Morgan's savings on all these things and your new profits, new business models potentially might shine a good light on the industry, but everyone else that is in this industry right now doesn't directly profit from it. Indirectly, maybe. But we're gonna have for me, crypto right now feels weird. It's gonna be what I'm saying is it's gonna be a longer transitionary phase. And now I moved far away from that question, what does RWA mean for interop, and made it more what does RWA make for DeFi, crypto, what does it mean for it? But yeah.
Quick note before we continue, about 96% of the people watching this aren't subscribed. You can see it right here. If this show has been useful, subscribing makes a real difference. It tells YouTube this is worth showing to more people, and it directly helps us bring on the founders and operators you want to hear from. So please, subscribe to the show.
I mean, for the user, can you just give them a peek into what kind of complexities you guys have to deal with so that a swap is done in a click?
Yes. So for LI.FI, the story is very simple. We are looking at exponential fragmentation across blockchains, multi-chain token standards, native token standards, interoperability solutions and exchanges. And now with RWAs, it's fragmenting even more. So we spent 5 years on building that orchestration layer or coordination layer at the top that allows to go in and out of any position. Very flexible, very modular, very chain agnostic, solution agnostic, at the same time scalable and enterprise grade reliability. So we have really been focusing on that specifically last year, because the years before, to be frank, we had so many scaling issues. It was like tough because we were growing way faster than we could handle. Now we have solved these issues, and we have that enterprise grade experience that Robinhood expects. Now, from here on, what have we really built? So it starts with aggregation of APIs and therefore data. I want to understand which assets are available on which chain ever, and at which price are these assets available. On top of that, I need to understand if I want to get from A to B, what are the potential routes? So smart auto routing, all of that is still on data level, right? Then you would ultimately end up with scenarios in which you would have to swap an asset so that you can bridge and then swap again. So this is complex, and it implies the user would have to sign 3 transactions. So instead of having to do that, LI.FI built a multi-chain transaction rail. This rail is a set of smart contracts that lives on all these chains and allows us to combine a variety of transactions into one. So we can bridge swap with the one transaction. Instead of sending a transaction to a bridge directly, it goes to our smart contract, and then the smart contract sends it to the bridge, and the bridge sends it back to our smart contract, and then it gets back to the user. These kinds of things, the ability to send meta information alongside that, unpack that, make sense of it, do that in a as gas efficient way as possible. That has been asked for the past few years. Now we are doing 2 new things. The one thing is, well, we have been able to bridge swap, and we have also been able to leverage the idea of calling any smart contract at the end of this complex transaction. But here it already becomes difficult, right? The idea of calling any smart contract at the end of like such a transaction, maybe an Aave deposit or a Morpho deposit or maybe Pendle or Hyperliquid, whatever. This is obviously hard to scale. If you think about it, all these protocols have different smart contracts, so it's really hard to abstract that, right? We offered that, and with many enterprise clients, we went down the road of writing custom smart contract integrations for all of these things. It was just not that scalable. So over the past 2 years, we have developed a virtual machine, and that virtual machine really expresses a domain-specific language in TypeScript. So you can type whole user journeys of check my wallet balance. If big enough, then if bigger than $1,000, take $1,000, swap it into X, and then deposit as collateral into Aave, take out a loan as much as possible, or just 75% of that, and then take this further to swap it into something else. Right? These kind of strategies, multi-chain, are now able to be. We can now express that in TypeScript, and we are getting executable call data out of that virtual machine. Not only that, it has its own transaction simulator, which is super fast and cheap. So we have actually call data we can rely on, and this allows us to make multi-chain journeys much more scalable. And this is very unique. We have really put in a lot of R&D into all of this, and we are rolling this out with big clients like Alipay now. And that's great. This is one thing. Another thing we have been doing is, so instead of just aggregating, because aggregation is also hard to scale, we now are pairing this with an open solver marketplace. It's essentially an intent system. It takes an intent and then it auctionizes it across a network of solvers. I don't really believe that the market is ripe for like very decentralized, massive solver systems yet, because there are not enough solvers and it's already profitable to run them. And the space is more fragmented than solvers could cater to them in an economic way. So aggregation is still the key solution for everything. But it allows us to plug in third-party liquidity. It allows all these people that tokenize assets to bring their own liquidity and market make it themselves. And we have all the distribution power. So in a sense, we are the best solution for anyone who tokenizes assets to actually find distribution and find their access into wallets of any kind, from a Ledger to a Trezor to a Robinhood to a MetaMask to a Phantom, right? Again, here, L.I.FI is really the middleman that brings these two sides together, and they can actually accelerate the adoption of tokenized assets. And that's something we are super bullish on, and what we're heavily investing in as a company right now.
Were there market conditions that demanded this kind of complexity into the product? Or is it something that you foresaw and then you decided that, okay, I think that the market is headed in that direction, and why not build for it right now rather than when the demand arrives?
We can start with the latter. Like for L.I.FI, it was just clear from day one. I joined the space in 21. In February, March, April, March 21. Never touched crypto before. I didn't even have a centralized exchange wallet, so I was late to the party. But I came into this with a very technical perspective. Actually, the first blockchain I ever engaged with was the, what was it called again with T? Trezor? No.
Tron?
No. Damn. There's they were sponsoring Formula One and everything. Not Tron, not Ton.
Tezos?
Tezos. Exactly. So the first chain I engaged was Tezos. I was like, wow, and I was actually excited about them because they were supporting a variety of smart contract languages. Like you could write your contracts in Pascal, you could write them in TypeScript, in Python. So that's great. Like if you think about it, imagine EVM would support to write smart contracts in a variety of languages. Like that would like kickstart adoption even more. I mean, Solidity
Okay,
is
quick question.
Yeah.
Why does it matter, and doesn't that increase complexity?
Certainly increases complexity for others, like for the chain and so on. But if you can write smart contracts in any language with certain frameworks, maybe restrictions, and then it compiles into smart contract code, I mean, obviously it just makes adoption much easier. So the Rust developer can write his smart contract as easy as the Python developer, as easy as the web developer that comes from TypeScript. So it just allows a faster adoption of blockchain if there would be more language. It has its downsides, obviously, because you need to maintain these frameworks, and compilation can be tricky, and languages are complex and are also still evolving. So it's not like that. Languages are frameworks themselves, right? However, I think that excited me about Tezos back then. And then I quickly moved on to EVM, understanding that this is where things are happening actually. But I came from a strong database background, and looking at blockchains, it was very clear, hey, blockchains are just databases. We call them execution environments sometimes, but a database is a execution environment too. So I'll give you an example. If you are in ad tech, if you go on a website and within a split of a second, they have to decide which advertisement to show you based on your past behavior and preferences. So it's obviously you as an identifier with lots of relational data of your past behavior, and that bidding, all of that has to happen. So these big ad tech companies, they often use PostgreSQL, and then they write the code within the database. So as scripts, like everything runs within the database itself. The database is the execution environment, like a smart contract runs on the blockchain. And however, like we looked at blockchains and were like, it has to be multi-chain. There was no other way that it would scale. It will all converge on one chain. There will be, and we're not even the end of it. We're gonna, as more value chains move on chain, we're gonna see blockchains for different data types like spatial data, graph data, or vector data, whatever. And then of course there's also a strong economic incentive to have your own chain for control, compliance, or simply a greater degree of value accrual. So we see this with Stripe and Tempo, Circle and Arc, Robinhood Chain. This is just the beginning of that, right? So very interesting. And for us, it was very clear from day one. And then the signs were also clear that we were not the only ones, because the second hackathon we did was around interoperability. It was like in the ETH Global hackathon around interop, where we met the Connects team, the Hop team, Optimism Arbitrum. So that already the signs were there from day one for us. And we simply placed a big bet on this, which was funny because even a few months later when we raised our seed round, many VCs were not seeing that. And fragmentation will, compared to the internet, fragmentation, crypto will remain real. And there are very different dynamics as well. Like in TradFi, you don't have the economies of scale that you have in crypto when it comes to order flow, for example. The degree of economies of scale here are much higher. So
Can
all
you
of these
unpack that?
dynamics,
Why we say that?
simply because settling transactions is more expensive. Well, there is a technical cost to it. Like blockchains have gas costs, cost money. And that fragmentation also comes with rent seeking at different steps. So if you can batch transactions, and if you have more data on where, like that, the fragmentation is so real that also capital efficiency is a whole different ball game. So the more data you have and the more order flow you have, and I separate these two things. Data, for example, can be quoting data, which gives you an indicator of where money is flowing to next, and transactions, order flow. The combination of these things is powerful, and that's something DeFi is optimizing for, right? We're optimizing for as much data and as much transactions as possible. And then later on, there is really where we can provide benefits to market makers or even market make ourselves if you want to go down that route. But similar what Robinhood is doing with Citadel, I think we have a very similar positioning down the line.
When you are just purely aggregating versus when you are trying to unify liquidity, how does one view that? I mean, what is the mental model to understand the difference between a pure aggregator versus what LI.FI is right now?
There is no pure aggregator. There are different kinds of scenarios in which aggregation makes sense. I'll give an example. Like what everyone knows is a DEX aggregator. That's what we grew up with in crypto. Yeah, the DEX aggregator makes sense. So you have a blockchain and you have multiple DEXs and AMMs. AMMs are based on liquidity pools. The price function of liquidity pools reflects supply and demand of that pool. But if I have from the same asset pair multiple pools, it would make sense to split a transfer across these pools through avoid too much of a price impact, right? The less you change the pool you tap into, the less price impact there is. And then you can even combine this with additional data you have around liquidity flows and optimize even further. This is what DEX aggregators are doing. And DEX aggregation, essentially, to simplify that, they split trades across homogeneous liquidity pools. That's a problem, and that's been solved by the 1inches 0x fly trades of this world. And now there is bridge aggregation. Bridge aggregation solves a different problem. For bridge aggregation, it's more like, imagine you have a bridge. A bridge supports different routes, different chains, but then per chain-to-chain route, often also different assets. So on Matic, you have a different native token than on Arbitrum. So obviously there is Matic as a token, and then on Arbitrum you need ETH. So you have this there, but then between Solana and Arbitrum it's Sol and ETH, and so there are different assets for different routes and so on. And then there are some Tempo from Stripe, they will support stablecoins as underlying gas token. So bridging is complex. The moment you want to aggregate two bridges, you have to map the different chains. These chains are expressed differently by different bridges. So Stargate, for example, they use shortcuts. They don't use chain IDs. They use like SOL for Sol or ETH for ETH. And then someone else, like Across, might use like the EVM native chain IDs. And then someone else that thinks a bit bigger and outside the Ethereum context might use the chain agnostic improvement proposals chain identifiers, right? So this needs to be mapped. That's a manual effort. On top of that, different assets. This is about route coverage, routing correctly, routing smartly, and then you might want to leverage data telemetry and be like, hey, we have these different routes for this A to B route. However, they have different bridging times, different costs, and different security assumptions. So you might be, well, actually, for this very large transfer, we would prefer mint and burn route. It's slower, but it's more safe. We definitely don't want to have a failed $10 million transaction, right? So we go for mint and burn. These things. So you need, again, this is really about smart routing in a more qualitative sense, less in a quantitative sense, like DEX aggregation. And then we are not operating with homogeneous liquidity pools, but with heterogeneous APIs. Totally different game. Bridge aggregation has nothing to do with DEX aggregation. Now, Li.Fi is a meta-level aggregator, if you want. So we are above all of that. So we do both and combine it. And we have our own bridging system as well, our own DEX aggregator as well, to cover up for gaps in the market. We want to ensure transaction delivery. We want to make sure we can cater to all our clients' demands. And very often these clients are new chains like Mega ETH right now, or they are enterprises like OKX, and OKX is a centralized exchange. Centralized exchanges over the past years have all been following the same strategy, which is have your own chain, have your own non-custodial wallet. So there is no incentive demand-wise to support OKX for any of the DEX aggregators. Historically, we have been knocking these doors. Now we can simply deploy our own DEX aggregator, and that's great. That just gives us less independence of third parties, but we're going to remain market neutral always. So if a new DEX aggregator is launching on that OKX chain, we're going to support that too. Yeah, but you can see like Li.Fi is just much differently positioned. We understand everything that's down below, and we aggregate everything that's down below.
So would it be fair to say that it's a combination of 1inch and dbridge?
Yes, in a sense, we have that intent system like dbridge for the bridging side of things. At the same time, we have our own DEX aggregator like 1inch, but on top of that, we also aggregate all the 1inches that are out there.
Right, exactly.
Right?
Yeah.
Because these DEX aggregators, they perform very differently. The DEX aggregators compete on smart contract efficiency, on algorithmic efficiency, and the amount of liquidity pools they tap into. And there's a weird trade-off they have to make. The more liquidity pools you tap into, the slower your internal reasoning becomes. So, for example, Odos has been incredibly good at generating very competitive quotes, but it takes them 2.5 seconds to arrive there, right? Like that's just very slow for a Binance that wants to have centralized exchange like connectivity. That being said, aggregation of DEX aggregators makes sense because they support different chains, and they are because they compete on the amount of liquidity sources they tap into. On different chains, there are different liquidity sources they can tap into. So it's really a race for each single chain to be competitive as a DEX aggregator. So having full access to everything, and our data shows that we have a very equal distribution amongst all the DEX aggregators we support. They're all claiming to give the best quotes. They're all claiming this is funny, but it is that's not the truth. They perform differently well, and it also depends on trades. Some optimize for larger trades, some plug in some PMMs at the same time to cater to these larger trades. Yeah, so they're all different. Aggregation and having access to all of them makes sense. And then again, also from the enterprise perspective, Leah is used because you want redundancy, right? If one of these players get down, you want to have a fallback, and you want to have a fallback for each scenario, for each route, for each chain. So that's why Leah has over 800 B2B clients a day.
How do their demands change from LI.FI? I mean, can you take a few types of clients and tell us as to, what are few things that are more important to type A clients versus type B?
Yeah, I mean, this institutional set trading desk has, for example, maybe demand for GUSD and PyUSD much more than a normal wallet has, right? And then a normal wallet has to cater to crypto retail, so they're much more keen and interested or have the need to be on the next new hyped L2. So last year we were looking at Chain, Sonic, Stables, Plasma, and so on. Now all eyes are on Monad, and now these days everyone's looking at Mega ETH. So for them it's a race, and therefore also for us it's a race to always be that day one. And we've been getting better at being that day one. Historically, we have been dependent on third-party bridges, so they had to deploy first. And they often only made it day one, so we had to catch up on that first day. Volume-wise, that was not optimal for us. Now we can land on chains day one ourselves. That is great. So less independence on third parties regarding expansion efforts. And other demands might be we have some wallets that want to support tokens that take a fee while swapping. Others are forbidding them. Some need better screening, some like AML related screening, chain analysis, ellipsis, and so on. Others need more or less of them. It's like, yeah, so the demands definitely differ here. Then also when it comes to non-EVM, that one wallet just got incentivized to launch on Ton or Tron. Therefore, they want to be there, and we are their swapping bridging partner. So we are getting pushed going there faster than we otherwise intended to. We typically try to gather as much customer demand for something as possible, but also, of course, we don't want to lose our major clients. Last year was crazy. Demand for Sui, demand for Tron, demand for so many other things. It was really intense last year.
Do you still maintain that? Or, I mean, what I'm trying to understand is what kind of an effort it is at an infrastructure level to add these things and to keep maintaining them.
Maintenance is a huge effort. Back then in the past, we saw so many things breaking that we really doubled down on observability. So we have shadow transacting or shadow quoting, or we do some, we have Grafana dashboards about all of our implemented solutions. Everything's very well monitored these days, and that allows us to proactively deactivate certain chains and inform partners, hey, it's not available anymore because of a lack of liquidity, for example, or that no one is offering a route anymore. There's native bridge, but we didn't see enough customer demand on your end. Maybe we deprecate this. So it's a constant dialogue with integration partners and with customers, and looking at general market data. We have a huge data team. We understand the market very, very well in terms of where is liquidity flowing, by whom, why, and all of that. So we have become quite good at foreseeing things and handling these things. But yes, everything is updating. So constantly there is something to fix. And there are also constantly new edge cases that come up. So we are 120 people now. We're going to be 200 people by the end of the year. And with RWAs, it's not going to be easier, right? Like there is so much more coming, but we are perfectly positioned for this fragmented future and being core infrastructure for this very fragmented market.
How do you think of growth? Would you say it is a lull phase or a bear phase, whatever you want to call? How do you think of growth in that time?
Honestly, I made a point where I'm ignoring these market conditions. I mean, I care from a metric standpoint, but LI.FI keeps on growing no matter if bear or bull. That's great. Of course, we also grow like this.
Right.
Wait, I should put this in stream. It goes like this, but it keeps going. It keeps going up. So problem is growing. Our solution is growing. The mode is growing. It's really hard now to catch up to us. And there was even thing with AI because we use so much data telemetry to optimize things already. That's just tough, and it takes a product in the market to understand what is it you need to build actually. You can probably use AI now to plug a few APIs together, but then
Right.
once you take it to market, you're like, oh, damn, I need this too. And then sure, you might be able to catch up on these things, but you need code you really understand because there's so many edge cases you need to handle. And I think with AI, it would still be very messy to do that. But at the same time, we have 70 developers and we make heavy use of AI now. Like AI is one of our major topics internally in terms of doing everything. And you just like we are not lagging behind in terms of leveraging AI to get somewhere. So we are just getting faster. Competition can build something fast too now, but we are also getting faster and building this out, hardening our mode, winning more deals, expanding, being more aggressive. So yeah.
Quick note before we continue, about 96% of the people watching this aren't subscribed. You can see it right here. If this show has been useful, subscribing makes a real difference. It tells YouTube this is worth showing to more people, and it directly helps us bring on the founders and operators you want to hear from. So please, subscribe to the show.
I'm curious about how that use has changed over the past year or so. I want to understand from a product standpoint, like, can you really trust that at this point, or is it to make sure that your productivity gets a boost?
Well, it's nice to smoke test. You can build prototypes within 24 hours, take it to a client, ask for demand, and then ask AI to make it open, adjusted to our existing interfaces internally. And so they're just things like in combination with large enough context, you can do a lot. I think it's really worth it by now if you have. So I was discussing this with a friend yesterday. In times of AI, it is even more important to have a microservice architecture. We had this microservice hype for a long time. Then people were like, back to monoliths. And we also started building LI.FI as a monolith, keeps you way more efficient with things. And microservices feel overwhelming. We turned back to microservices as we had to scale. And now with AI, it's really worth it to have microservices because you have isolated code, so you can reduce the overall scope and context the AI has to operate with, in terms of understanding certain interfaces and whatsoever. And that's just a design choice that really matters nowadays. And it allows us as a company to play around, test. A lot and go to market faster with certain things.
Was this very conscious that you wanted to go to businesses as clients? I mean, 800 clients don't happen overnight, right? There must have been a strategic decision as to, this is where we want to go.
I've never seen DeFi B2C as sustainable, except for the very few money markets like Nava that have something adorable. But even Alpha for me is a B2B play more. Today is a B2B play. It's just if you think about it, this makes sense. So for me, from day one, it was clear. I was only always believing B2B here. The modes in times of AI are brand, distribution, data. If you leverage historic data for data telemetry, like data you have to accumulate, that is the mode. and its network effects if you have that. So those are 4 things. LI.FI has all of them. We have a strong brand within the space. Now need to tackle TradFi and become more known in that area. We have strong distribution. We leverage our data, which is potential competitors will only learn that as they go to market and wonder why, if they would benchmark us against them, why we are performing better. It's because we make heavy use of data telemetry. Then the third is network effects. And we have the tool in multiple ways.
Intents have been pretty big in this space, but they're not everything, right? I mean, I think you've said that intents don't necessarily solve interop on their own, and there is a lot that goes on beyond just enabling intents. Can you unpack that?
Unpacking what intents allow us to do? Yeah, intents. So in general, the intent system we have per se is a special one. It supports multiple transaction flows. So you might have heard of resource locks, but also Cross came to market with 7683. And then there are different ESCOM mechanisms you can also use. LI.FI's intent system supports all of them. So any flavor, which is great. So whatever you want to put an emphasis on as a business, you can use that. Also down the line on the verification side, so what are we using to verify these things? You can go with a wormhole, you can go with a polymer, you can go with a layer 0. We support all these things. That's beneficial too, because again, it allows us to cover many use cases in different contexts with different requirements on security, or speed or costs, whatever is necessary, whatever is important to us. And then we also support a variety of transaction domains. What I mean by that is same chain swaps, bridging, and we can easily add more. Like we can also add perps or lending intents or whatever. Like you're really flexible across the stack, and that makes our system very, very special. None of the other ones have that. Other ones would be like a Cross or a dbridge or a Uniswap X or a 1inch Fusion X. These things, right? Like we have built a system. We waited for a long time to address the topic intents. Like, and this was one of my hardest choices back then. I saw this intent narrative coming up, and I was like, "Hold on, what's happening?" And obviously, it was from a theoretical standpoint, it was a real threat to LI.FI. But with everything in life, especially as an entrepreneur, timing matters. So when do you do the right thing? And we waited patiently. And then there was another narrative, chain abstraction, which is technically what we have been doing since day one. But again, something we waited out and not overreact, not pivot into AA like account abstraction, not pivot towards gas abstraction, not doing all these things. Then we had the ability, the chance to buy Catalyst. I invested in Catalyst myself a few years ago as a business angel. And then we eventually bought the company, which was a great choice. Alexander and Jim are incredibly smart and driven, and have built, in my opinion, the best system in this market when it comes to intents and intent execution. So very happy about that. However, still LI.FI remains solution agnostic, market neutral. So any other intent system is also implemented or will be implemented. And it's going to be a fair auction across everything.
What made you hold back from intents for such a long time and then go and acquire?
An intent system is a multi-sided market, or solver network is it's a multi-sided market. And the way you execute a multi-sided market is, well, you have a chicken and egg problem. You don't get the solvers if you don't have order flow. You don't get the order flow if you don't have solvers. So the best way to execute this is to proxy one side. Tell me, Saurabh, how would you proxy the supply side in an intent system? Well, you would aggregate the execution. LI.FI has been executing a marketplace strategy from day one, right? So I knew I would be perfectly positioned to build this out. I also knew that the first thing, like 7683, we were looking at the standard back then, and we're like, is this the end of it? We saw the downsides of it. we're like, okay, there are probably other things out there. So we just did more research and we waited a little bit. And we also want to understand different auction mechanisms. So we looked at CowSwap, looked at 1inch Fusion, looked at Uniswap X and all of that. And we wanted to understand where is all this going. And and then once we felt confident that we have seen enough to make a choice here, whom to buy or to build ourselves, we made it.
In terms of competition, look, I've seen the dashboards. More often than not, you guys are the leaders, right? But only the paranoid survive. What do you think of competition in general in the space?
In terms of direct competition, nothing comes to mind by now, right? We had some direct competition in the past. Direct competition kind of for us doesn't really matter anymore. There are some, they have a few deals, but they don't really matter to us. And then there is the frenemy situation we have with many of the people we aggregate. Frenemy essentially means we are friends, but also there is some competition in there. A bridge will always prefer to be implemented directly than being put into competition by being aggregated and then in a B2B integration. However, the reality is that top-level applications prefer to have redundancy and fallback mechanisms and best price execution and the best route coverage possible. So aggregation wins in 9 of 10 out of deals. The only time we lose deals if one of these players have been talking to a certain company earlier than us or have a deeper relationship because they were able to build it in person. This is really it. And so that being said, we are uniquely positioned, and the velocity at which you close enterprise deals is insane. And that's great. So very happy about that. And now we have a technical mode and a data mode and a brand mode as well, because we are known for what we are doing. And that is, we are just raising a new round, and we see people doing customer interviews, and the feedback is there is clearly no second solution that's enterprise scale, which is just great to hear, right? Like, I mean, we know that, but it's also great to get this confirmed by our clients, and now we can really double down on becoming, just like improving the quality every day. So getting better, faster, more reliable, more robust, more enterprisey. No, we are in a very lucky spot with all of this.
So I'm curious about your views. First of all, do you think there is any merit in saying that there is no endpoint to fragmentation and it just moves from one layer to another? And if that is true, how do you anticipate the next level at which crypto faces this problem and you guys are there to solve it?
We will have fragmentation for another 10 years easily on multiple levels. So if you look at existing rails, right now we have like DeFi rails and we have CeFi rails, right? Li.Fi has been in the middle aggregating DeFi rails. However, now we see new rails coming up. We see compliant rails happening on top of DeFi rails. We see like they are more compliant solutions, or just like where we know that those are untainted liquidity pools. Everything has been KYC, KYB'd. There's know your transaction as well. And then we're going to see privacy rails. So privacy rails are also up and coming. Bridges, dark pool, DEXs, and all of these things that would allow institutions to remain private with whatever they're doing. It's up to Li.Fi to also aggregate these different types of rails that are coming up. So again, another case for Li.Fi. Another big fragmentation we're going to see is around RWAs. If you think about a bunch of companies tokenizing stocks and wanting to add meta information to it, we need to standardize these things, right? Maybe we can take on existing standards we know from TradFi, but again, there will be fragmentation across different asset representations on chain, and as more and more value chains move on chain, and here I have to say, I see tokenization as the successor to digitization. We will see more value chains coming on chain. So once we see a vehicle being represented on chain, or a real estate, or a mortgage contract, these things again will need to be standardized to be tradable. There will be new risk markets coming up. So there is a whole new future of financial products coming. over the next 10, 15, 20 years. Like, this is amazing. Like, blockchain and the whole industry has an amazing future ahead for which DeFi is building. And we can help navigate these standards. We can map them. This will be the task in the beginning. And then we will certainly play a major role in shaping standards in the future. And this is really a position LI.FI wants to get into once that becomes more relevant. For now, we will just map different standards, different stock representations, for example. I don't know, someone then names their stock like the name, and the other one names it stock name. So we need to map this, right? We have been doing this in the past too. And yeah, different rails, different token classes. I'm also pretty sure we're going to see more token standards. Tempo is working on one too, and they won't be the last one.
Going away from the technical stuff, right? I mean, someone who has just entered crypto, how do you explain LI.FI to them?
If someone just comes to crypto, or how I explain LI.FI to them?
I mean, how do you explain what LI.FI does? Or you don't care about people who have just...
To someone just there never touched crypto?
I mean, just started trading, just use one chain, nothing else. Let's say they have MetaMask and they are on Ethereum.
Oh, because people say, hey, we like a sky scanner for your asset movements.
There
Like,
it is.
you want to get from A to B, you're trying to find the best route, or like a Google Maps even. I like something like Google Maps more. Skyscanner is price comparison, and Google Maps is really like, hey, you have to walk 5 minutes, then you have to take the train for 2 hours, and then you can take the car for another 45 minutes. But because there is no train and walking is too far, take the bus, right? So and then you can buy a ticket for all of that at the same time.
Yeah.
So so this is kind of LI.FI.
Google Maps with some sort of a ticketing facility where you can do end-to-end ticketing.
Exactly. Yeah.
Nice. I like that. In terms of immediate problems that, I mean, LI.FI wants to solve, can you share a couple of them, given that you have shared all the rails and all the places where fragmentation will appear?
That's really it. Getting RWAs to find distribution is a big problem we want to solve. And the second one is simply just like the exponential fragmentation we are facing. That's it.
So as a founder, you must have had situations where, they are not easy. You had to deal with a lot of stress. What is your advice to younger founders or new founders who will have to go through those tough times?
Yeah, my advice here is really to see stress as something that is in your head. Stress is self-made. It's induced by external factors, but it's still self-made. And therefore, you need to get familiar with a variety of tools that allow you to deal with stress. And one tool, which is a bit separate from your mind, it's your body, right? So you need to, your body is a tool for your mind to deal with stress. So stress hormones are being released and you need to deal with it. So we should optimize with this first tool you can't separate yourself from, which is your body. So take your body and understand what it takes to let this machine run as efficient as possible, right? Which is nutrition, exercise, and sleep. What does it mean to have sleep hygiene? What does it, even if you have constant travel, and I can tell you, like, I live out of my suitcase for 4 or 5 years now. I travel once a week. I'm on a flight, right? At least. And this is still, you can design everything to respect your body as healthy as possible. I'll give you an example. I really optimize the days I'm flying by only having at maximum 1 cup of coffee in the morning because it's dehydrating your body. The biggest problem with flying is dehydrates your body. So I take only 1 cup of coffee. Otherwise, I refuse caffeine that day and try to abstain from anything that dehydrates. I try to eat before I get on the plane. I try to avoid the dehydrating food on the plane. I take electrolytes before, during, and after the plane. I drink enough water. Staying hydrated keeps you arrive much more fit. You arrive and your immune system stays intact, right? exercise. There is no excuse to not do sports. Either you have to book a more expensive hotel, go into a 5-star, there is a gym, no matter how shitty that is, take it. If you travel constantly, there are solutions like Urban Sports Club in Europe or ClassPath in the US. You can find your classes. And otherwise, just go for a run or go for a swim. You will find a way. Do sports. And sleep again also. There are very basic things. Half an hour before you go to sleep, at least put your phone away. Start reading books again. These things. And then this is on the physical side. On the mental side, there is something called therapy. Have it. Go to therapy. Or get coaching at the very least. Start journaling. Like have something. It doesn't have to be that one book. You can journal on any piece of paper. Get your emotions out. Right. And if that's not it, call your friends at least. Call your friends, tell them about your struggle. Or talk it into your phone. Make voice notes to yourself. Be like, vent. Get it out. Get emotions out. There are so many tools you can do. I tried a variety of things like Panchakarma, which is like an Ayurvedic retreat, did amazingly for me. It also means dealing with anything that in general keeps you down in life. You have to be high functioning, not only as a founder, but in private, because there is no such thing as work-life balance. As a founder, it's all just life and work. And you have to combine these things. So you might as well optimize the private side. And if it's childhood trauma, maybe go there, right? If you don't feel loved by your parents, call them, confront them, whatever it is. Just like work on it's constant work on yourself. And as you progress, your company will progress. And this is one thing. It's one symbiosis. And this is what you have to understand. So I try to constantly work on myself. And there are so many little things you can optimize. Have that cup of water in the morning with a pinch of salt and lemon. Be hydrated once you get up. Get these things going. Be more efficient. I drink my coffee without milk because the flavonoids are easier to absorb. These things, like there are so many little things you can do. Take care of yourself.
Yeah, do some Wim Hof breathing, right?
Yeah, pranayama, go there, do some yoga as well. It does wonder for me. Yoga is something I've been very fond of for many, many years. Unfortunately, I kind of lost track of it over the past 1-2 years due to the constant travel. I'm bad at doing yoga at home. I like to go to classes, and as I travel, it's just harder to find good classes. Bad excuse. Would any avid yogic would say it's a bad excuse. But no one is perfect. Whatever feels right for you at the time. But there are ways. But you need to. You are the brain of the company. If you're not functioning, your uncertainty, your weaknesses will ultimately reflect on the company.
What is next for DeFi? What should people be looking forward to?
Oh, Leah is launching a checkout product, but not in a traditional sense. It's a conversion tool, and it's amazing. Can't wait to launch this. So this will come and will make the space rethink how we think about chain abstraction. We also we have just launched our intent system. So if you are a solver or if you need distribution for your RWAs, talk to us. We have solutions. And apart from that, we announced Composer, our multi-chain composability tool I mentioned. We introduced this in Buenos Aires at DevConnect. Again, it's we have a lot of demand for this. But again, this will really change how we are able to navigate this multi-chain environment, and everything will become much more seamless and fluid, and we are truly building the rails across DeFi.
Is there anything that I missed out on that you want to talk about?
I think that's it.
That's
We covered so much. We covered the problem LI.FI is solving. We covered the products we are building. I'm incredibly bullish right now. The whole
That's
company is. We are very excited, and the market confirms that we're doing the right things. And I couldn't be more happy to be where we are right now.
All right. Thank you, Philip. Thanks a lot for spending the time. Really appreciate it.
Likewise, thanks for your time.